Welcome back to Investing Talk Podcast.
Today we're looking at Carlisle. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there is a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Carlisle is, well, it's a really interesting one right now. You've got this core contradiction playing out.
Contradiction? How so?
Well, on one hand, they just put out a pretty solid Q3 2025 earnings report. Looked like a clean beat, really. Operational win.
Okay, yeah, I saw that. They beat EPS expectations, right, by about 2.5%.
Exactly. $5.61 reported versus the $5.47 consensus. And revenue, too. It came in a little over expectations.
$1.35 billion. Yeah, about a 1% beat there. So operationally, things look, pretty well executed.
They do. Management seems to be navigating things well. But, and this is the big but.
Uh-oh. What is it?
The stock has a Zacks rank #5.
5. It's not the worst one. Strong sell.
It is. Strong sell. The highest level of caution they signal. So you have this beat, this operational success.
And then this really negative rating hanging over it. That doesn't quite add up on the surface. Why? If they just beat...
It's all about the revisions. The Zacks rank isn't really judging the last quarter so much as it's looking at what analysts are doing now with their future estimates.
Ah.
And the trend is unfavorable. Analysts are cutting their expectations for Q4 and looking into 2026 pretty rapidly.
So the faster they cut, the worse the Zacks rank gets. It's like a momentum indicator for analyst sentiment.
Precisely. It's reflecting the velocity of those downward revisions, not necessarily saying the company's fundamentally broken overnight.
Got it. So it's a warning about the near term based on analysts getting nervous.
That's the crux of it.
Okay, but before we dive too deep into that nervousness, let's talk about why Carlisle gets attention in the first place. This isn't some flash in the pan, right? Fundamentally, it's been a strong performer.
Oh, absolutely. Yeah. You look historically, the performance is impressive. Trailing 12-month revenue is sitting at $5 billion.
And that's up, what, over 9% year over year?
Yeah, solid growth. But the profitability is where it really shines. Net income for 2024, it soared up over 70% year over year.
70%, wow.
Reached $1.31 billion. So they're not just growing the top line, they're dropping a lot of that to the bottom line. Real cash generation.
And the margins, too. I mean, even with the current concerns, they're still guiding pretty high for 2025 adjusted EBITDA margins.
They are, mid-20% range.
Yeah.
That's quite resilient when you think about the headwinds they're acknowledging in the construction markets.
That speaks volumes about their competitive position, doesn't it? Their moat.
It really does. Their core is commercial roofing and the building envelope.
Building envelope? Can you just quickly define that for listeners?
Sure, think of it as the shell of the building. Everything that separates the inside from the outside walls, foundation, roof, windows. It's crucial for things like energy efficiency.
Okay, so they make components for that. Why is that such a strong moat? Is it just good products?
It's more about the systems. Carlisle sells integrated systems, roofing, waterproofing, insulation, all designed to work together. Once an architect specs a Carlisle system,
it's hard to switch out.
Very. It's costly, complex, could void warranties, so they get locked in. And that creates a really sticky replacement and maintenance business.
Ah, so it's not just about new buildings going up. A lot of their business comes from re-roofing and upkeep on existing buildings, which is probably more stable.
Much more stable than the boom and bust of new construction, yeah.
Yeah.
That provides a structural tailwind.
And you see that quality on the balance sheet too, right? Not too much debt. Good liquidity.
Exactly. Moderate leverage, strong liquidity, they generate consistent free cash flow.
Which lets them fund innovation like their Vision 2030 plan.
Right. Focus on high ROI stuff, sustainability.
And pay a dividend. What's the yield now?
Just around $4.40 a share, so about a 1.3% yield. Not huge, but stable and growing. It's a picture of, solid financial health.
Okay, so we've established market leader, strong moat, great profitability, healthy balance sheet, which brings us back to the big question.
Why the strong sell warning?
Yeah. Why are analysts slashing forecasts if the company is this fundamentally sound?
Because the near-term macro picture is rough, and analysts are reacting to that. The fundamentals are strong, but they're running into cyclical headwinds.
Okay, so what are the numbers showing? How bad is the expected slowdown?
Well, remember the $5.61 EPS they just reported for Q3? The consensus for Q4 drops pretty hard.
Down to what?
Around $4.43 EPS. And revenue is expected to dip too, down to about $1.14 billion for the quarter. That's a noticeable sequential step down.
And management isn't really fighting that narrative, are they? Their own guidance is cautious.
No, they're validating it. They've guided for full year 2025 revenue to be basically flat, zero growth.
Ouch. All due to softness in construction end markets.
Primarily, yes. And maybe more concerning for investors who focus on profitability.
The margin.
Yeah, they're projecting a 250 basis point decrease in margins for the full year because of these near-term conditions.
Okay, 250 basis points. Let's translate that. That's 2.5 percentage points off their margin profile. That sounds like a significant hit.
It is. It means less profit per dollar of sales. It could be from having to lower prices to win business, or maybe input costs are rising and they can't pass it all on right now. Either way, it hits cash flow.
And this industry, diversified operations, it's pretty tied to the economy overall, right? Construction slows, interest rates are high. Carlisle feels it.
Directly.
Oh.
So analysts see this slowdown, they see management guiding cautiously, and they start cutting those future numbers. That's what's driving the negative revisions in the Zacks rank. They're pricing in a couple of tough quarters.
Right. But then, okay, here's another twist. Technically, the stock itself isn't exactly falling apart, is it?
No, it's fascinating.
Yeah.
The sources point out the stock price has actually maintained a bullish trend. Higher lows, higher highs.
And it's trading above its key moving averages, 50-day and 200-day.
Comfortably above both. So the price action itself doesn't scream panic.
Plus, it has low volatility, beta close to 1.
Yeah, beta is 0.99. Moves right with the market. Suggests stability, quality. Not typically what you see before a collapse.
So this is where it gets really interesting for an investor. You have the Zacks system flashing red, strong sell.
Based on those rapid estimate cuts.
But the overall analyst consensus, the average rating from all the analysts covering it, is actually buy.
It is. 6 analysts covering it. Average rating is buy. And their average 12-month price target is around $390.
Which implies what, 15% upside from where it's trading now?
Roughly, yeah. So a total disconnect between the short-term momentum signal and the longer-term valuation view.
Okay, so let me see if I understand this. The Zacks sell is like a warning light for traders. Hey, momentum is negative right now, earnings cuts are happening fast, maybe wait.
Exactly. It's a timing signal focused on the next 1-3 months.
Whereas the consensus buy and that $390 target are saying, look past the next couple of quarters. Fundamentally, this company is worth more. The downturn is temporary. It's a valuation call.
That's a perfect way to put it. Short-term noise versus long-term signal.
And which side are the big institutions leaning towards?
Seems like they're siding with the long-term view. Institutional inflows are reportedly strong. They seem to be using this dip, this period of negative revisions, as a chance to buy a quality company cheaper.
Okay, so for someone listening trying to decide buy now or wait, it really comes down to what happens next. What are the key catalysts we need to watch?
Timing is absolutely critical here. The next few months could really swing sentiment. First up is November 2025.
What happens then?
We get Q4 guidance, and they usually have analyst days. Management really needs to deliver a message that puts a floor under these falling expectations, stabilize the narrative.
Okay, then the actual Q4 earnings release in January 2026. If they beat the lowered bar.
That could be a positive catalyst. Could start to turn that Zacks rank around.
But the really big one, you think, is February 2026.
Based on the sources, yes. That's when they refine the full year 2026 guidance. That's their chance to show a clear path out of this soft patch. If they can paint a picture of accelerating growth or margin recovery for 2026, that could really reverse the negative trend.
Makes sense. Beyond those scheduled dates, are there any sort of wild card catalysts? Speculative stuff?
There's always chatter. We're seeing mentions of potential activist investor interest.
Because the stock has underperformed a bit, despite the quality.
Exactly. An activist might push for things like buybacks or portfolio changes to unlock value.
Speaking of portfolio changes, any rumors there? Acquisitions or divestitures?
Yeah, some speculation about potential activity in early 2026. Maybe selling off a non-core piece to focus or making a bolt-on acquisition fits with their Vision 2030 strategy of optimization.
What about margins? Any talk of specific programs to counter that 250 basis point drop?
There's some buzz about a potential new margin expansion program. A focused effort to find efficiencies, maybe target getting back 50 or 75 basis points of that lost margin internally.
And inevitably, when a good company's stock dips, M&A rumors, Carlisle as a target.
Unconfirmed, of course, but yes, that chatter picks up. Could a larger industrial player see value here if the price stays depressed? It's possible.
One last one. Anything related to their Vision 2030 and sustainability, new partnerships?
Yes, rumors about potential tie-ups with solar or energy efficiency providers.
Yeah.
Integrating renewables into their building envelope systems would be a big validation of their innovation strategy.
Okay, so pulling it all together, how do we summarize this for the listener?
I think it boils down to this.
Hmm.
Carlisle is fundamentally a high-quality company. Strong market position, proven profitability, good balance sheet. It's not broken.
Hmm.
But you absolutely cannot ignore the near-term headwinds reflected in those falling estimates and the strong sell rating. There's likely some pain ahead of the next quarter or two, particularly on the margin front.
So it's a classic conflict, long-term fundamental strength versus a clear near-term technical or sentiment warning.
Exactly. It's a test of an investor's time horizon and risk tolerance.
So the key question you have to answer for yourself is this. Are you willing to look past the next couple of quarters, tolerate that potential margin pressure, and buy what seems like a fundamentally solid company at potentially a better price now, believing its moat will see it through and that the February 2026 guidance will be the turning point?
Or do you wait? Wait for the November guidance or even the January earnings, pay potentially a slightly higher price, but get confirmation that the worst of the estimate cuts are over and the outlook is stabilizing.
Here really is the decision point, isn't it? Weighing the quality against the timing risk. That's the entire thesis here for Carlisle.